Hello everyone, thanks for checking out my video. Major indices and stocks retreated last week as Nasdaq snapped their 8-week winning streak, while the S&P 500 ended its own streak of 5 consecutive positive weeks. The current rally is starting to run out of steam. It seems like investors are starting to digest the possibility of more interest rate hikes from the Federal Reserve, and as a result, reviving the worries of a negative impact to the economy. Anyway, the key question now is this pullback a healthy one, or is it something bigger brewing? Stay tuned to this video as we discuss further. So, last week, all 3 major indices broke their very own multi-week winning streaks. Specifically, for Nasdaq, it posted its worst weekly performance since March this year. And just last Friday alone, we had more than 400 stocks in the S&P 500 trading in negative territory. Last week's decline was likely due to the comments from J Powell and his team. But the funny thing is that Powell didn't break any exclusive news. He was merely doubling down on his view on Wednesday and Thursday that 2 more interest rate hikes are on the cards to curb inflation. That being said, Powell's tone sounded relatively hawkish by saying that the current inflation number is very far from the Federal Reserve inflation goal and that they have a long way to go to achieve their goal. On a separate note, other central banks around the world are also increasing interest rates, some unexpectedly. This could have also affected investors' sentiment as they may view that the same could happen in the US. In terms of market outlook, I think this is the time to watch some of the leading stocks closely and see which names are holding up better than others amid a market pullback. For instance, Apple and Meta didn't act like there is an ongoing retracement as Apple quietly hit all-time high again, while Meta continued to rise to a 16-month high. Just to share, in a bull market, strong and leading stocks tend to bounce off support levels during a pullback. More on that later in the technical analysis segment. Meanwhile, this coming Friday, 30th June, we will have the release of PCE number, aka Personal Consumption Expenditures. Again, in case you're not aware, PCE index is the Federal Reserve preferred measure of inflation, though typically stock market reacts more drastically towards CPI number. Anyway, at the moment, PCE has shown little signs of easing since the start of the year, as April's 4.7% year-on-year growth matches that of January this year. Therefore, investors will want to see a softer inflation number this week, and maybe the stock market could cheer a little from there. But if PCI inflation shows little progress again, it may challenge the current risk environment and Powell's hawkish speech could really play out. Finally, in about 2 to 3 weeks' time, the earnings season will arrive again. That period will be a key catalyst and it could potentially set the tone and direction of the stock market in the second half of the year. And if you are trading options with expiration dates in 1 month's time, you may want to check out the earnings calendar a little bit and not get caught off guard by the volatility. Moving over to the technical analysis segment. If you followed my last video, you will know that SPY was about to hit resistance at the green dotted trend line, which is the top end of the uptrend channel. And as we can see, SPY has somehow respected this trend line and retraced before even hitting it. Okay, to the bears out there, 3 things for you to watch this week. First of all, a switch over to the weekly chart will show us a bearish Hanami pattern. This suggests that the price may reverse to the downside. But the caveat is, nothing is guaranteed in the stock market. Next, going back to the daily chart, the last time when SPY hit a super overbought zone for RSI was 16 August 2022, and it was followed by a huge decline. So on 15 June this year, exactly 10 months later, SPY hit this overbought area again. In fact, it was even more overbought than in August 2022. And right now, SPY is declining. So come this week, the third thing to watch is the MACD. If MACD starts to cross down, then weakness could continue. On the downside, the first support is around 420 to 421. This is where the gap is, as well as where the first Fibonacci retracement level sits. To add on, as shared last week, 420 has been a magic level that investors and traders are watching. So it becomes like a psychological level. That makes it a triple support area, where bulls should put up a decent fight here. If this 420 level breaks, we could then potentially slide towards the bottom of the channel where we can find another triple support at around 405. This is where another gap lies between 405 to 407. and where the second Fibonacci retracement level sits, as well as where the bottom of the uptrend channel is. Alright, let's discuss the bull thesis. Going back to the RSI, a caveat is that last week's decline has brought the RSI to a neutral zone. From here, it can really swing either way. I mean, I know that's equivalent to stating the obvious that it can go up or down. The point here is don't be too fixated that that decline will be as massive as August 2022. In terms of the upside, the resistance will be none other than the recent high of 443 and also the top end of the uptrend channel. So give and take a little bit, I would say around 443 to 445. From this point, the next resistance is April 2022 high at around 452. If we were to reach this level in the near term, it's actually quite significant because that will likely see SPX above 4,500 too, a level that Goldman Sachs expects to reach by year end. Moving over to Apple, Apple is currently approaching the area of resistance. In fact, it has tested the Fibonacci extension level at 187.5 on 3 occasions last week and got rejected. Despite the rejection, it didn't stop Apple from creating a new all-time high. Come this week, I think we can expect Apple to test this 187.5 level again. As usual, we need good volume and sale about 2 green candles above it, then the bullish momentum will continue. The next target or resistance will be the second Fibonacci extension at around 195. It's so high to the extent that the chart doesn't even show it. Okay, some fun fact, I realized that over the years, whenever Apple hit an all-time high, it was usually followed by a big decline. To add on to this, I have also previously shared that whenever Apple went on a parabolic run-up, the next decline has always been quite significant. I know Apple looks unstoppable right now, but sometimes you just need to be patient for things to pan out. And again, sometimes I could be wrong too. On the bearish thesis, there is a RSI bearish divergence formed last week, and the MACD looks flat but could cross down anytime. Therefore, watch how Apple tests the resistance level this week. If sellers keep stepping in, we can expect MACD to cross down and the RSI bearish divergence to play out. Support-wise, because it is at an unprecedented level, I don't see a lot of support at the 180s range. In fact, I drew a Fibonacci retracement line from the recent top to March 2023 low. The first support level is actually below 180. I am not showing it here because this chart will then look very messy. Anyway, yep, the first meaningful support below I would say is around 175 to 176 where the gap is and where August 2022 high sits. If Apple falls to this level, it will not get me too excited, but I may consider picking up a few shares. I will be more excited if it goes towards the big gap between 166 and 170. Alright, let's now talk about Tesla. So last Thursday, I posted on Moomoo that there is a bearish engulfing candle formed on 21st June Wednesday with a significantly high volume. In addition, there was also a bearish divergence on the RSI. Therefore, it's not surprising that Tesla closed red on Friday. Okay, here's something for you bears out there. You recall earlier on we talked about bearish Harami pattern on SPY's weekly chart. Now we have it here on Tesla's daily chart too. On top of this, if you realize, Tesla has also hit the resistance level of the red dotted downtrend line, and more importantly, it got rejected. That's quite a fair bit of bearish signals. But just to be clear, I am not saying that it's for sure that Tesla will slide further down. I am merely presenting what I have seen, and currently the bearish signs are showing up more than the bullish ones, so please extrapolate what you see fit. Anyway, on the downside, the first support will come in at 247, aka the Fibonacci retracement level. If this level breaks, the big gap between 235 and 244 will be the target for the bears, and I think we will feel it quite easily if 247 gets breached. Support should come in around 229. Let's say, okay, Tesla somehow wants to slide further down. The very key support level is actually at around 196 to 200 area. This area is super crucial because it is the key Fibonacci level as well as where the current 200 moving average sits. And oh, before I forgot, watch the MACD closely next week. If it crosses down, I think we can say hello to 240's range again. Meanwhile, a quick side note, this channel needs your support to keep it going. You can support it by simply tapping on the like and subscribe buttons and also comment something below. This will help to signal to YouTube that people are watching the videos. Other options will be either to sign up for a Weibo account using my referral link or buy me a coffee at USD $3. Okay, going back to Tesla, let's say Tesla being Tesla, if it decides to go against the odds and rocket up, the upside will be to test and break 277. In order for it to be really bullish, it needs to close above the red dotted trend line for a few days. That will then potentially brings us to the psychological level of 300 as FOMO buyers continue to step in. Well, 300 itself will be a resistance, followed by 315. The latter will be a heavier resistance. Moving over to Google. Google looks pretty straightforward to me. As shared in my previous video, Google has been range bound, moving between 120 to 125 for the last 26 days. If you had sold some put or call options here, I think your contract will likely expire worthless. Anyway, this is not the first time Google has been consolidating within a tight range, and as mentioned previously, the Bollinger Band is squeezing, so we just have to wait for the next potential huge movement. If it decides to head down, I would think the gap between 113 to 114 will be easily filled. This gap itself is a support. If it doesn't hold, check out this consolidation range at the bottom. We could then head towards there. The range is about 100 to around 108. In terms of the upside, the gap at 132 will be the first target, but Google really has to break free from the 125 hurdle. So at 132, we then enter the top consolidation zone, ranges from 128 to 145. Wouldn't be surprised if the second gap around 139 to 140 gets filled as well, if we officially enter and close within this consolidation area. Moving over to option trade segment, last week I actually placed orders for 2 cash secure puts, but sadly they didn't get filled. I will cover this in the end thought segment. So since I didn't manage to open a new trade, I will update some of my existing trades that are still open. Let's begin with something negative. I mean, nothing to hide, right? So for this covered call on Google, it's not a positive trade as it looks on the right. Let's recap on the sequence of trades. I first sold this covered call on 21st April with a strike price of $110. Expiration date was 26 May. The premium received was $240. And then Google went parabolic. Therefore, I wrote this option by closing it and reopen another one. Basically, I closed it by paying $1,175 and opened a new covered call contract with $1,055 premium. So the math goes like this: $240 minus $1,175 plus $1,055, which gives me $120. I will earn this $120 premium if only the current contract expires worthless, which is unlikely because the expiration date is this Friday, 30 June, with a strike price of $113. So I will likely roll this option again to a later expiration date and a higher strike price if possible. Alternatively, I may let the contract expire and my 100 Google shares will get caught away at $113. If you recall, my cost price for this 100 shares is $100. So if it gets caught away at $113, then I will profit $1,300 plus the $120 premium that I shared earlier. Therefore, the total profit would be $1,420. But I am not inclined to do this as we are in a bull market and I would like to retain these 100 Google shares if possible. But if it gets caught away before I roll the option, well then so be it. Okay, I have 2 other put options, but I will not update here because there's nothing much to highlight. You can check out my very last video for more info on those trades. So I decided to update this super interesting trade, a covered call on Tesla. Quick recap, I sold this covered call on 31st May. The rationale behind this trade can be found in the video link at the top. Anyway, the strike price for this covered call is $285. Expiration date is 7 July. Okay, here's the interesting part. As you can see, just last week alone, the trade swung from 940% to 468% and then to 245%. That's a 700% swing. In case you wonder why do I even bother to cover such heavy loss in this video, well, to clarify, what you see here is not a loss unless I close the contract. My intention, again, is to show viewers, especially newer option traders, on how wild and massive the swing can be when it comes to option trading. And oh, if you are just starting out on options, please check out my options for beginners video at the top. Anyway, back to this trade. Tesla is currently sitting slightly below $260, so my trade is safe for now. As long as it does not go beyond $285 by 7 July, you will be able to see how the negative 245% turns positive. It's quite amazing. But I don't have control over the market, so Tesla may just moon to $300 in the next 2 weeks. And when that happens, I will just do what I have done for Google's covered call trade, to roll it out to a further expiration date and up to a higher strike price. Okay, hope you learned something today if you are new to options trading. If so, I would definitely appreciate a like button. Meanwhile, come this week, let's see how the market moves, and I will assess if I can open more options contracts. Alright, as usual, some end thoughts to go along with this video. As shared at the start of the video, all 3 major indices declined last week. I wouldn't say that we didn't see this coming. In fact, this long-awaited pullback is something that I personally was quite looking forward to. To me, such breather is healthy in a bull market, and I talked about this in my last 2 videos. And at the moment, it does seem all is well as we are not seeing a massive dump, and if anything, this retreat is quite orderly in some sense. In fact, I would say that the various tech giants such as Tesla, Microsoft, Nvidia, Apple and Meta are doing a great job in this market pullback. They are either retreating modestly or holding their ground, aka flat, or some are even marching higher. We haven't seen any huge sell-off in these mega cap stocks at the moment. Okay, so what? Does this mean that the market pullback is almost finished? Well, it's possible. I mean, some stocks have found decent support levels and are bouncing off them. That was why I tried to step in last Thursday and Friday as I placed a few trades, but they weren't filled. I was basically trying to sell cash secured put options on Google and Tesla again, and this is a slight bullish move. To add on, I was also trying to snap up some of these 2 stocks. Personally, I feel that the market hasn't cooled enough yet. That's probably the reason why my orders weren't filled, as I wanted to see if it can go a little more lower, just a little more. Well, you may disagree, but for me, I do think that a little more pullback from the current level would be helpful and useful. And to be honest, I wouldn't be surprised if the pullback carries on into this week, or remains choppy with wild intraday swings but ended up flat, which happened to some of the leading stocks last week. Anyway, all being said, I believe that the current pullback is giving us some buy the dip opportunities, especially if you have lots of cash piling up from last year or early this year. Therefore, you may want to build your watch list and map out a plan with entry points for the stocks you want to accumulate in the long run. The only quote-unquote concern or problem is that this year, every 1 to 2 days of decline has been met with a rebound that could last a couple more days. I shared this in my previous videos. In other words, stocks have recovered their losses pretty quickly this year, and that was also why my trades weren't filled last week. Therefore, if I see a stock in a consolidation phase and before it starts recovering, I may consider stepping in already. I did this for Google about 2 weeks ago. Tried to do it again last week, but I think I set my price a little lower. By the way, this is not a financial advice, okay? Finally, before you get all too excited and FOMO, as usual, some words of caution. Despite the recent pullback, there are a few leading stocks that are still pretty stretched in terms of their valuations. To add on, some of them have gone up in a parabolic mode with lots of euphoria, excitement, and FOMO. In my opinion, this makes them more vulnerable to declines. To borrow some stats from Refinitiv data stream, the S&P 500 is currently trading at 19 times its expected 12 months earnings, well above its historic average of 15.6 times. And historically, the S&P 500 has experienced a median drawdown of 14% over the next 12 months when valuations stand at current levels or above, compared with a 5% drawdown over a typical 12-month period. These numbers are from Goldman Sachs. Okay, but just to clarify, I am not saying the market will decline more than 10% from here. I'm just presenting some stats to all viewers. To some of you, stats may not mean anything, as those are past performances, which does not guarantee future results. so feel free to extrapolate what you deem fit in your market analysis. Statistics aside, personally, I will keep in mind some of the potential catalysts that could affect the market outlook in a negative manner, which include more hawkish tone from the Federal Reserve, a surprise rise in inflation, and unexpected weakness in economic growth. Again, this does not mean I am bearish towards the stock market right now. It's more of keeping myself in check and not to FOMO and make reckless trades. By the way, as I am recording this video, it seems like there is a major event developing in Russia. One moment there was a potential civil war. Next moment, it seems like it's not happening already. It's a developing situation, so you can Google to find out a little more. Not sure how this will affect the stock market this week. Alright, before I end this video, just wanted to check how many of you have bought shares since the start of the year. Let me know in the comment section below. With that, I have come to the end of this video. Please help out the channel by liking and subscribing. Thank you.